Good morning, everybody. Welcome to the Flow Show, the day after the night before. And the Fed heads have done their thing. Now we need to know what the Whitehead is going to do over at the ECB. That's the next one on the list. Morning, guys. How you doing?
Good morning. Hello, everybody.
Morning, mate.
It's a little bit cooler here, which is great. It's only 37.
Oh, you're lucky. It's been raining here for 2 days. And it's set to rain for the next 2 weeks. So you enjoy it, mate.
Lovely. Nice weather for ducks.
Nice weather for ducks in my pond. Yeah, definitely. Right, so lots to get into and over today. And then before we take a look at what's coming up for the ECB, PBOC still fixing things on the low end, 7.1265 versus 7.1295 yesterday. There was a bit of data out overnight. I haven't checked to see if it's on this calendar. Let's have a look. Oh, yeah, it is. Industrial profits not looking too hot. Coming in down 8.3% year on year, and year to date down 16.8%. So very negative numbers coming in there for those guys. On the stimulus front, let's call it that, or the plans to pick up the economy front, China apparently going to push for tech-related loans to help maintain fast growth. So lots more tinkering going on over there in trying to spark some life into the economy. Coming over to the Bank of Japan, and no real news out from those guys, but what we have seen the last couple of days is a big load of hedging coming in against a possible move from the Bank of Japan. There's always going to be hedging around these meetings. It's a natural reaction, but there's been a big pickup in short-term hedging. Just traders taking a bit of risk into account that they may do something at this meeting, and so they want to cover their arses. So apparently these hedges, according to Bloomberg, have hit a 4-month high. So this is against the risk of a yen surge. So as you can see, big of a pickup there, which can have an effect in adding to the volatility over the event, because either some of those hedges are going to get unwound or adjusted after whatever moves, or if the hedges haven't worked, i.e. the protection isn't needed because the BOJ isn't hawkish, well, that gives particularly yen short the ammo to go and short more. So either which way we look at this meeting, it's likely to be a big price event in terms of the moves we're going to get. Kay, you see anything more on the hedging front?
I was looking the past few days at well, they call it the smile, right? In the options, the puts are massively overbought, massively overbought, but not in the sense of it's too high, but the price of puts is massive versus calls. What it tells me is two things. Either it's protection against very short yen positions, and those protections will get taken off if the Bank of Japan is dovish enough, or let's call it unhawkish. I don't think we can call about dovish. And then you should see a collapse in the vol, and especially in the price of the puts right after the Bank of Japan, and that should actually underpin dollar yen or send the yen a little bit lower, because the correlation between vols and the yen is historically that if the vols is high, it's usually a sign that yen is could be strengthening. On the other hand, if the Bank of Japan is hawkish and sends dollar yen down, there's another two options that are possible. Is we are going to find bids because people have been speculatively buying those puts, and they are going to start to hedge their gamma, or we are going to have a big acceleration because there's going to be a gap down there because you got a lack of buyers. So this could be one of those two things. But initially, it should mean that, of course, we don't know the the strikes that have been bought, but I suppose that if you look at the shorter end, I don't think that they will have been buying anything below 138 or 137. In the longer term, it could be different, but I guess in the 137, 138, there's going to be bids to hedge those speculative put buying, and it's actually not only on the short term, because if I look at the put call ratio in even on up to the 1 year, it's massively for dollar yen puts. And we have to know that they have been paying hefty prices for those, because not only the volatility is high, but also they get punished on the swaps. If you buy yen outright, you're going to pay the funding up front. So they have been paying massive amounts for it. So they better be right. That's what I'm saying, really, on the back of it. But yeah, it's pretty hefty. If you look at 2 weeks, puts being around 15, 16, 17 even percent. The 1 week you talk about 20%. Those are decent prices to pay. I don't know if you have on your page the picture of the what we call the smile, or the yeah, there you go. I've got it. My picture is a bit smaller because I've got it even steeper than that, to be honest. Yeah, but anyway, there we can clearly see that people are paying up for puts, right?
Yeah, so it's all about the volatility numbers that Kay's talking about here.
Yeah, and on that picture below, you see the left-hand side, which are the puts, are much higher, and the prices are much higher than what the calls are. They usually will be because of the swap differences, but today particularly they are very high.
Yeah, and people have to remember that if people are hedging for a certain move in one direction, okay, they're taking these trades out. There's a counterparty to those trades, so the people who are selling the puts to these guys are going to have to hedge those positions as well. So it can have almost a netting off effect in terms of the market pricing, or what the spot price does, because these guys might be sitting in 2 week puts or week-long puts or something, so they're happy to sit in that. But the counterparty, the people who sold those puts, are in a position now, they have to go out and hedge that. So that's why you can see spot moves now related to this hedging for a week's time, so to speak.
Yeah, but they have already done a bit, because if you look at how the puts are overpriced versus calls, that means that not a lot of people want to sit on those positions right now. It does tell us, though, that we may find some really good levels after the BOJ, but it also does tell us that if the BOJ doesn't do anything, you're going to see a massive sell-off in options, which is usually negative. So there's something in the option market to keep in mind when you trade, actually, and the speed of the market as well.
Yeah, and I mean, all this might look like gobbledygook to many of you. It often looks like gobbledygook to me a lot of the time. But how we can use this, you can see dollar yen, these vols overnight, 1 week, 2 week, 1 month, out to a year, much higher than all the other major currencies. So what that can tell you for trading something like the BOJ, what's useful for you if you don't know what's going on in the options market or don't understand them, is that if you're going to get a price move, it's going to be big, or could be big, bigger than what we saw for the Fed last night, which was next to nothing. So going into the Bank of Japan, there's high volatility. There's a lot of hedging being done, which could add to those moves as well. If you're going to be trading it, you're not going to be trading tech levels within a 50 pip range of the spot price going in. You need to widen your horizons. You need to look at levels 100, 150, 200 pips either side of the price going in, if you're going to look to trade, because it's going to be a lot of noise and a lot of volatility in the middle there. That's where you don't want to get caught out in the middle. Let the market do its thing. Know where your potential stretch points are if there is a big move. But be ready for the volatility that's going to come. And if you know that, it gives you half a chance not to get caught out by it. But anyway, back to the rest of it. Bit more Aussie price data as well. Import and export price indexes out as well. And again, negatives coming in there. Export price particularly down 8.5%. Import price is not as bad, down 0.8%. So still potentially seeing lower prices coming into the country, but not coming down as much as expected. So that might keep a little bit of inflation pressure in the pipe there for Australia. But overall, more minus numbers coming in these different price metrics that we're seeing around the globe, things like PPI as well. So the trend is definitely for lower prices. It's continuing, no signs of letting up just yet. Over to the BOC, and we had the minutes out yesterday, or their latest deliberations. They're saying they're willing to raise rates again, but don't want to overdo it. They discussed delaying a rate hike at the last meeting. They will weigh rate decisions one at a time after the July meeting. The consensus among members that the cost of delaying action was larger than the benefit of waiting. They see concerned progress towards price stability could stall. Inflation could rise again if upside surprises materialise. So that keeps them, I'd say, a touch more on the hawkish side of the scale. Not full on hawks, data dependent like the rest of us, but concerned that the job's not done on inflation. So that'll feed into thoughts for the next BOC meeting. Further on the data front, just some housing data. New home sales came in a little softer than expected yesterday. Where's it gone? There we are. So new home sales 697 versus 725 expected and 715 prior. So down 2.5% over last month. On the house price front, median prices were a little bit lower than last month, 415,000 versus 416,000 previously. That was down 4% on a year ago. So still seeing just a little bit of easing in the pricing, nothing that warrants any red flags being waved. Inventory was up as well. New home supply stood at 7.4 months versus 7.2 months previously. So that's a metric that counts how long it would take to shift all the inventory of new homes. So 7.4 months, when that number increases, it means it's taking longer to shift homes, which means there's more homes on the market. So that's ticked up a couple of points there. Right, so let's get stuck into the FOMC. They hiked by 25 pips as expected. The decision was unanimous. There isn't much in the statements anymore, the initial statements. There's no real hints of pathways or anything like that. They dropped that sort of thing out back in May when they dropped out that they saw it appropriate to continue hiking type thing. That's dropped out in May, as I say. The only little change they did do was they upgraded their statement. In the first line of the statement, there's a line on economic activity, and they basically upgraded economic activity to moderate versus modest. Sounds like a small thing, but sometimes these word changes can spark the market changing its mind about things. It hasn't really done so on that, but just to give you an idea, the last time we had a change in that language was back in September 2022, when they changed it from softening or softened, the economy softened, to modest growth. So that gave a little bit of a hint that they saw a difference in the economy. Powell used the term moderate when talking about growth all the way through the presser yesterday. So as I say, it's just a little upgrade on their thoughts for how they see the economy. But back in the comments and the presser, Powell said, and he really was, I would say, neutral. He gave a bit on the hawkish side, he gave a bit on the dovish side. He gave something, he took it away. if we talk about doors and whether doors are open, he sort of said something that closed the door to another hike, then said something that opened the door, and it was that all the way through, closing the door and opening the door, closing the door and opening the door. So he said growth in consumer spending has slowed from earlier in the year. Getting back to 2% has a long way to go, talking inflation. Expects it will take time for the full effects of rate hikes to be realised. So even those two comments still saying that inflation is a way to go, hinting that rates are going to stay higher or could indeed go higher. But then it says it takes time for the full effects of rate hikes to be realised. Then he said, we believe monetary policy is restrictive, which is probably the most dovish line he gave of the night, calling pretty much a top in rates. Then said there's no decisions made about future meetings. June CPI was welcome, but it's only 1 month's report. So no victory laps, not getting too excited that inflation is coming down. He says it's only 1 month's report, but they've seen inflation coming down for the best part of a year now, if not a year now. Then said core inflation remains pretty elevated, and they're going to need to hold policy at restrictive levels for some time. Doesn't think that policy had been restrictive enough for long enough to bring inflation to target, and repeated there's still a long way to go. Then said that stronger growth over time could add to inflation and could maybe require a policy response. A little bit of a hawkish nod there. He said September move depends on the data and we don't have it yet. So as usual, firmly in data dependency mode. So he doesn't think there will be rate cuts this year, although he pointed out, and this is according to the last dots, that several FOMC members expect rate cuts next year. So he's getting that out in the open, the potential for rate cuts. And he didn't say he doesn't see rate cuts until next year. He just says he doesn't see them this year. He says if we see inflation coming down credibly, we can move down to a neutral level and then below the neutral level at some point. They could be cutting rates while continuing QE. Now, a lot of the market pretty much now saying this is the end for the Fed hikes. It's the last of the cycle. Probabilities standing today are 80% that the September meeting is unchanged, 20% for a 25 pip hike. Now, before I bring the other guys in, as I say, my thoughts are I was expecting maybe to be a bit more stronger on the keeping rates up and a potential for another hike. But as I say, he was pretty much sat on that fence. He gave something, he took something back on both sides. So the market has been pretty neutral. I don't think it's changed its mind in thinking that we are at the end of hikes, even if we get another one. That'd probably just be icing on the cake. So the market is at the end of the rate hike cycle, potentially for the Fed. It's seen some dollar weakness. We were heading that way already, so I'm not sure how much more we can do on that front. But obviously, for euro dollar, the ECB comes into the mix today as well. What do you think of it, guys? Are we? Is this definitely a top now, or will they go a bit more? And what's the dollar going to do?
Well, for me, if you don't mind, I'll. Okay, you want to go first? Yeah. Well, okay. For me, you are right. Powell gave us a little bit for both sides, but I think the dovish parts were stronger than the hawkish parts. Yes, they changed the word from modest to moderate, or how was it? I can't remember which one it was. But, telling us that it's restrictive, telling us that, rate cuts are not cutting, but maybe in a year's time. Well, that's what the market's pricing anyway at the moment. We're pricing the first cut by May of next year. So we were pricing, if I recall, yesterday it was 12 basis points of more hikes that we were pricing. Now we're pricing 7. So we've lost 5 basis points, which kind of makes sense. I think the top is in. In terms of rates, I really don't think they're going to be hiking again. As I said before, if it wasn't for the markets pricing it fully, I don't think they would have done it. But they are definitely restrictive, their policy. By the way, when was the last time a decision was not unanimous in the Fed. It kind of annoys me. You know, you see the Bank of England, you have 1, 2, 3 dissenters sometimes. The Fed is like always unanimous, which I don't like that. I'm sure there are voices from both sides, but in the end, they all toe the line and they follow the leader. But anyway, back to the what I think about rates, etc., and the dollar. I think barring any surprising economic data, that being inflation basically not dropping further, we are done with the rate hikes. Excuse me. The next FOMC meeting is September. So we have 2 more, I think late September as well. We have 2 more CPI prints before that. And I think the most likely scenario is we head towards 2%. If we are, even if we haven't hit 2% in September, if we're at, low 2s, I don't think there's any reason for them. Excuse me, something wrong with my throat. Hold on. Sorry about that. I don't think there's any reason for them to say, oh, we have to do a lot more. Inflation is high. Look, inflation is dropping and it's heading towards target. Whether that's a good thing or not, we've talked about it many times. I don't think it's the right thing. We should be seeing negative inflation, but that's not what they're going to do. They're going to want to hit target and stop as soon as they're there. And I think the direction is still there for inflation. So I think we're done with rates. The dollar, I wrote in the chat room yesterday, for those of you who are members, the Dixie was trading at around 101 or, it was above 100.80. It was 101 or something like that, above after the meeting. And I said I wouldn't be surprised if I wake up tomorrow morning and it's below 100.80, which is the big level. And I woke up and I saw it was 100.69. So that was funny. Anyway, I think the dollar is going lower. What confuses me a little bit is that yields are not going lower. I think they will follow, but for now, yields are remaining resilient. And but my main view remains the same. My macro thesis is the same. Inflation is dropping worldwide. Price pressures are abating, and for that reason, I think central banks are going to be more on the dovish side than they have been before. And I think we're close to the top in both the ECB and the Bank of England. I think the Bank of England might have to do a little bit more. But they're going to follow the Fed's lead. So my view remains the same. I'm not changed from yesterday. If anything, Jay Powell's interview yesterday, the Q&A, solidified that. Yes, as I said before, that he gave us a bit of both sides, but I think the dovish side was stronger. My humble opinion, as always. And also, just to say something before I forget, equity is still strong. Resist the temptation to short. That's my advice. Obviously, you can do whatever the hell you like, but it just keeps going.
No need to break the trend, as they say.
Exactly.
Yeah. Well, thanks for that. Thanks for those thoughts, mate. Kay, how about you? Dovish or unhawkish or what from Powell last night?
Agreed. Exactly what we were saying yesterday. He covered virtually every single base that you can imagine. He covered it. I think it's like Stelio says. First of all, let's go backwards on the equities. I agree that the central banks are at the end of the hiking cycle, but the market should not be surprised by it. Now there's this correlation between higher equities and a lower dollar. On the yields front, I think the short-end yields could start to come off, and that's but the longer end perhaps staying a bit higher if the economic data hold up. And now it's all going to be about the economic data. I think the trend in inflation is clear. The broad trend is clear. It's coming off. So they won't need to hike anymore. That's one thing. But now it depends for the more medium term, whether for the dollar, whether the rest of the data holds up. So whether they can hold on to high rates for longer. He did say himself over the meeting that he sees potential rates coming off in a year's time. Okay, give and take a couple of months. It could be that the market is bang on and May is the one, but if inflation comes off rapidly enough. But still have this feeling that, well, I mean, you have to distinguish dollar and dollar, because I mean, if you look at the DXY, it's more than half is euro, and yeah, we saw cable rally again up to 130. That is something that we expected also earlier in the week, that sterling was going to remain a bit more resilient. But to me, those rates can stay high for quite a while, and euro dollar will probably be decided by two factors today, which is those the ECB, of course, and but also those Q2. There's a slew of US data coming out this afternoon as well, and we have to look at the combination. So yes, the market likes to buy euros, or euro dollar likes to sell dollars, but I'm still unconvinced that we are going to break ranges in stuff like euro dollar. So if you look at dollars, I think some other currencies may be better to trade than the euro dollar, because I think the ECB could be their last hawkish meeting today as well. That's my opinion, and therefore we might have this blip also end of month. There's a lot of stuff going on, but yeah, I'm still not favorable to a break of ranges in the euro dollar, regardless what the DXY is doing. But let's say I'd rather do crosses than trade dollars right now. But yeah, overall, again, he gave everything to everybody, much more balanced than it was before. But I think the rest of the central banks will follow, right?
Yeah, I agree with that. Well, I'm going to make a bit of a call. I think from the end of this week, and it may take a bit of time over the summer to kick into gear, but I think we are now going to start trading, properly trading rate cuts in terms of when they're going to happen. It doesn't matter if the Fed go and hike again in September. What I see is the market now seeing a top in rates and now trying to guess when the rates are going to come down. Fed are saying next year sometime, no cuts this year. If that data falls off a cliff in the next few months, the market's going to be screaming for rate cuts, and that's what we're going to be trading. So I think we are now peaked in rates, or close to peaked in rates from a lot of the central banks, and I think we're really going to start trading it. So every data point is going to mean, do they keep rates up or are they going to cut, rather than are they going to hold or are they going to hike? So that balance, that shift is going to be the trend that we're going to be trading, I think, from now on, particularly from the end of this week, once we go over the ECB and the Fed. But we should also keep it in context. You know, we're not talking about rates going from 5%, 4% all the way back to zero and negative and all that sort of stuff. We're talking about rate cuts down to a neutral level, which may be a bit higher than what central banks first thought. You know, rule of thumb, 2.5%. I think we might be 2.5%, 3%. So you're only talking 200, 250 pips of cuts to get down to a neutral level. So you going to have to take that into context when looking at price moves. We're not going to see a complete reverse of what we saw in dollar yen, you know, running all the way up from near the 100s to the 150s. Obviously, a bit in part to what happened with to what the BOJ was doing, but you know, we're not going to be seeing this coming all the way down to 100s again. Not on 250 pips of rate cuts for the Fed. But you never know, because if the Bank of Japan are suddenly hiking while everyone's cutting, that divergence is going to close pretty quick as well. So that's my thought anyway. I'm going to make that prediction that this is the start of the rate cut trading expectation cycle, which has been tried to kick off at various stages. As we all know, the old pivoters have had a go now and again, but now they might start to pick up speed on that sort of thing. What we did have today was, and I think perhaps this has been a mixture of this hedging after the Fed, a pickup in hedging after the Fed, but we had a bit of steep move through 140 down to 139.40 overnight. There were some in the market saying that institutions have been selling dollars today. State Street Global Markets popped up with that headline. Again, pretty much on the back of that, this is the end of the Fed hike cycle. Their chief economist or macro man said the market wants to latch onto any whiff of the immaculate disinflation narrative. So already we're seeing the market siding with seeing rates coming down due to pressures like disinflation, not deflation, disinflation, which is a completely different thing. Right, just to finish stuff off, Meta earnings was a bit of a blow the doors off last night. Came in very strong, saw the price kick up some 9% in the aftermarket straight after those numbers dropped. Other US earnings also been coming out pretty well. And yeah, something for I want Kay's response to this one, that the Japanese government for administrative tasks are going to employ ChatGPT to do some of the work for them. Big pen pushers, those guys over there. Is that a big step, Kay?
Well, I don't even know how they're going to do it, because most of them, they are still asking you for 10 copies of paperwork for everything you want to do. So and I don't even know how they're going to start it. But yeah, it's a big change over there. If that would accelerate administrative jobs, it's a big change over there, and which is funny, because Japan is or used to be at the forefront of all tech developments and robots and cars and stuff. And but if you look at the administration, it's still pretty horrible.
Yeah, that may not sound good for employment numbers as well, if they're going to have to get rid of 10 people stamping paper.
Yeah, but it's still the very tight over there, and yeah, and actually, we can talk about that another day if you want. But doing that is probably not even going to weigh too much on unemployment, because the aging of the population, I don't know if you saw the report earlier, but the record low births over in Japan. I think they topped like something like max 800,000 or so births over there last year, and all 47 prefectures showed a slowing again. So for my ultra long term yen, it doesn't really change my view. I still think yen is slowly but surely imploding. Japan.
Yeah, definitely. Another one put in the 25-year lag pot, like Yoeda said the other day. So quick straw poll from you folks in the chat. Are the Fed done? Mike, you say one more hike from the Fed left this year. What about the rest of you? Are we at a top for the Fed now? Are we at peak rates, or is there going to be another one? Just give us your thoughts in the chat there. We have a quick straw poll on that one. Nick saying they're done. Okay, yeah, keep them coming. Looking at dollar yen now, my plan is in play. I was long dollar yen from down at 138. I tipped it out over the Fed at 140.40s and turned it short. Added a bit more to it on the way down, 20s and 17s, 21s and 17s, I think it was. And the only thing I didn't do last night was stick in an overnight partial profit take, which I often do if I'm leaving a trade overnight, just in case you get a big move. And we got a big move, so I missed that one. We are a bit more balanced this morning. We've been back below 140, we're now back above 140. It's a little bit don't know what to do next type price action at the moment. I'd like to see it below 140. I've left some room in my plan to add if we get a decent rally. Obviously, we've got the GDP today, which could be big. That could cement or undo thoughts that we've now traded since the FOMC. So I'm prepared to hit a rally if we get one to run into the Bank of Japan. But I would prefer if we move down. So I've got some margin in the trade to run into the BOJ. That way I can bring my stops down further. I can minimize my risk as much as possible going into that event. But we shall see what happens. What is clear from the price action coming after the Fed is that we're continuing this move down off the 142s, up near the 142s. We're still making lower highs, we're still making lower lows. So, you know, this short-term sentiment is still in play, and there's been nothing from the FOMC to change that. If it had, we'd probably be trading up above 141. We're not. So you can see what the market's doing here. It hasn't done a lot over Powell. You know, pretty much NAFL 30, 40, 50 pip range over the FOMC. But now the market isn't pushing one way or another, likely because we've got that Bank of Japan risk going on. So for my trade, I'm in it. I'm happy with it at the moment. I'll see how it develops. There's enough time to pass under the bridge before we get to the BOJ, so anything could happen. But I would like to see it down under 140 and hold it under there, just to say, give me a bit of margin to play with going into it. But the Bank of Japan is going to be another decider. We're still in that position where, you know, we come out the end of it, we could be at 137 or we could be up at 144. You know, we really have that much price risk going into this one. So it's hard to pick a trade out of this. You know, you can scout the big levels if you get them, but you really want to be careful holding it onto a short-term position, running it into something like the BOJ. Guys, what are your thoughts on the yen in particular, just at the moment?
On the yen,
yeah,
I have no clue what to do with the yen. I mean, my natural temptation is to get a long yen, so short dollar yen, euro yen, maybe not sterling yen. But bloody BOJ never turns hawkish in any way, so that scares me. I really don't know what to do with the yen. I'm really sorry. No help there.
No worries, mate. Kay?
I should know what to do with the yen, having traded it for 30 years. But yeah, I'm going to be in Stel's camp, really. And I think you may be very right, Ryan, to have flipped around. If the market trades the lower dollar for long enough, but Bank of Japan will need to help, right? Or markets will need to start crapping the bed. If economic data across the globe start to crap the bed, and then you're going to have a longer lasting strong yen. But I'm afraid that if Bank of Japan doesn't do anything now, we are going to see this round of the options, the hedgers selling out, perhaps even carry traders coming back for another month and a half, or nearly 2 months until the next meeting or so. I really think this one is a tough call. I usually have a pretty good idea about what's going to happen, but the only near certainty I have now is that it's going to be volatile.
Yeah.
And really, I'm watching 139, 142, as I said yesterday, first range, and then probably 137s, 145 on the top side. Those are the levels of no return for now.
Yeah. So here's a thought, and I've only really just started thinking this since after the FOMC. Now we know what those guys are doing. If the Bank of Japan sit on their hands and we get a good rally in this, is that something to look at anyway as a short on the dollar side? So dollar yen particularly, rather than the crosses. Is that something to look at now? We know that the Fed is potentially at the top, and effectively rates have only got one more direction or one direction, and that's coming down. You know.
Yeah, but are you going to front run a 5.5% differential, or it's not a 5.5%, right? The US 10 years is at 387. It's not at 5.5, and the JGBs are somewhere in the 40s, I guess, 40 BPs, 45. So you have effectively 3.5% differential for them. Because that's what they trade the most. But are you going to be long yen and pay 3.5% away for as long as the Bank of Japan doesn't move?
Yeah,
I don't know, man. That's going to be, to me, still the key. Are people willing? Okay, it's moving fast enough, the dollar yen or other yen process. They're moving fast enough to cover the interest differentials, and it's not because of a currency has higher interest rates. We've seen it in the past, blah blah blah. That the currency needs to be bought. But are you willing? But in yen, it's perhaps slightly different because you have a lot of carry and funding forces at play.
yeah.
Are you going to stay long yen for longer term if you still, and if the Bank of Japan is still not moving the interest rates? I mean, you're going to have shocks, and again, then remains the question: what is the dollar going to do? What are the real data telling us, like growth, labor market, and the equity markets? To me, it's still very tough to be long yen for a longer period. And even though we've seen those moves in the euro dollar cable back to nearly 130, I don't know. The yen is a different animal in my opinion. Yeah, look at those crosses, right? Look at the euro yen, look at the sterling yen, for instance. They are still trading. They are not giving back a lot, right? I was looking at this euro yen close to 155, which is going to be the level of not the level of no return, but a very, very good pivot for that pair, and we are holding above. If you really want to be long yen, that thing should start to come down as well.
Yeah, no, it's a fair point what you're saying about the carry. That obviously is a consideration, even with this trade that I've got on since yesterday. But I'm purely looking for a BOJ reaction rather than sitting in anything for long. You know, unless it drops 300 pips, and then I've got some room to play with the carry as well. I'm just thinking more general sentiment. You know, is the market just generally going to hit dollar rallies now?
I think we are in a dollar rally selling environment for now. If you look at most of the pairs, you know, like the other guy said, it's complicated. And really, it is complicated. Yes, you sell dollar rallies selectively. You can perhaps do it in euro into the end of the month, unless the US data surprise positively this afternoon. And in yen, it's going to be the same. You probably sell 142 as we've seen, and now we're in the middle of this whole pack. You know, well, the yen is to me still going to be the more difficult one to buy versus others, because even the ECB is at 4% now, right? So and the Bank of Japan is still at 0.5% if you look at the YCC. Yeah, I mean, it's always going to be more difficult, I think, to buy yen for as long as the Bank of Japan doesn't say, like, okay, now we are going to normalize, guys. Then you will have a shock. Yeah,
definitely. We have to wait for that day. Yeah, I think what it does do, you know, if you're in lots of cases, if you're going to jump in to fight against these moves, then you've got to pick your levels, pick your poison, pick your currencies, and look at it only for a smash and grab. You know, I think. But then if you get another move to 145, it's a big old level. That is something that, if it's going to hold again, would mark a pretty decent double top. You know, you only need to, you know, quickly grab half of this type of move, and you've got some decent money in the bank. And then you can afford to, as I say, wear out some of that carry just to see if you can push it a bit further. But you've got to keep an eye on that swap cost, because it will eat away at your profits pretty quickly. But yeah, I think sniping off, you know, the big levels is going to be something that is worth looking at as well. Coming into some of the other pairs, well, you know, as said, we're seeing dollar weakness across the board. It's not going great guns. You know, we're not getting close to recent highs in euro dollar, but again, ECB risk today, so we could be up there by the end of it, or we could be back down and moving under 110. You just don't know. That's the effect of these events. You know, it's binary risk. No matter what we think and presume might happen, guess what might happen. It's a binary risk. The ECB will do what they want to do, and we can only judge after. But we know the levels that are in play. You know, we had a move last night, yesterday, down to the 110s, or Tuesday night rather. That's a bit of a level. It held down there. Now we're having to move up. Where's it going to go? Is 112 going to feature? If you can't get through these levels, no matter what the ECB is saying, then it gives you conviction to try a trade on it. Same down here. If we get down here and we can't get through, then what are you going to do? You're going to sell it right on a support level, or you're going to try it the other way. You really got to react to the price action. That's all you can do, and then take the information from the ECB into consideration. What does it mean? Are they in a similar position to the Fed? Are they hiking now and, you know, drawing down expectations for a SEP hike? At the moment, a SEP hike is still pretty strong for the ECB. You know, it was priced at something like 60% chance of a hike in September. You know, it's nailed on for a hike now. Are we going to see those expectations coming down? If that's the case, you're going to see euro dollar back down at 110, and then you've now got a weakening Fed, a weakening ECB. Which side wins out in the currency? That's all the fun and games you have to play for. So just same homework as yesterday. Pick your levels, know where you would like to trade, where you think you can have a low risk option to trade that, where you're not going to get caned. You don't want to be mucking around in here, because you could be up here or down here straight after the ECB. So sit on your hands, wait for the price action to do its thing, wait for the information to come through. Similar story, Aussie dollar. You know, we've had this break up through 68. Is it holding? Not really. We're having a little bit of a mooch around. We're not sure if we're going to carry on going higher. I'm not sure if the dollar weakening further is going to happen, give us a move up to 69s. Are we heading all the way back to 67s again? There's a lot of these coin flip markets at the moment, and it can be hard to trade, hard to pick a trade. You know, as we were just saying with dollar yen, it's hard to know what's going to happen next. You need all the information to come through. Euro sterling, again, this is on the back of that usual volatility difference, let's call it that, between cable and the euro. Cable pushing up much harder than the euro is. So therefore we're seeing, sorry, the euro is pushing up.
We just had this.
We had the CBI data as well. Oh, there we go.
CBI data out, which were crappy, and the euro sterling just went 50 points higher on the back of it.
Yeah, minus 25 for the CBI distributed trade.
Is that data released early?
No, 11 o'clock.
Well, I don't know, because sterling, well, cable dropped like 25, 30 points, of course. Perhaps a bit of profit taking into 130, but cable dropped 25 points just before. I'm just wondering.
Yeah, it's not usually. Yeah, not usually a big mover. I mean, yeah, we saw a bit of a move yesterday. Those CBI industrial trends numbers,
which were better.
The distributive trades. This is the retail side of things. This is like wholesalers. And things like that, so it's more consumer focused. But anyway, that seems to be a bit of a pop there caused by euro sterling. I'm still long this one, still looking for a dip, maybe down to the mid to lows, 85 to add back in the stuff I cut. 86, as you can see, we're knocking on 86. 86.10 is the level up here as well. So this is one pair I'm going to be watching closely over the ECB. And then cable, there we go, a little knock up towards the 130. That's the main level above. We got to what's the high, 95 before the little pullback. So again, you know, these are the levels you put on your chart. These are levels that had saying things previously. These are the ones you want to keep an eye on. If we can't get through here, well, there's only one way the price can go otherwise. Anyway, Kate, I don't know what I'm doing today. Do you want to know? Do you know what you're doing on some of the other pairs? Want to have a look?
Yeah, I can have really a quick look.
I don't know if you got anything in Swissy, Roberto, in the Q&A.
Yeah, I saw the question. I'll touch on it. I'll touch on it.
Yeah, no worries. All yours.
Okay. Since it's ECB day, euro dollar. The euro dollar. Have a look at where we went to. I showed this already on the daily. So this level here, 112.75 is the magic number to me. Going into the ECB and those US data, because again, I can't stress enough. I have to say that we don't only watch the ECB. There can be a double whammy or an opposite effect coming out of US data. If the US data would surprise upwards, even with and the ECB is kind of neutral to relatively hawkish, I would expect the euro dollar to find buyers on dips for the time being. But again, we are also trading end of month value date. So people in our room and people who have been listening to this show for a long time, they know also what that can mean for the US corporates. But so this is going to be the magic level on the top side. Then on the downside, if we go a little bit, and we are actually on a bit of a trend line right here around 111.5. So that's the first zone to keep an eye on as well. But ahead of the ECB, it's a bit useless to try and guess what's going to happen. Yesterday, I did try to counter the euro rally up into the 111 zone, but I bought them back this morning. I'm very and I'm actually pretty lucky. I bought them back. Better lucky than smart, as they say, because I bought them back for virtually flat, and it rallied 50 points since. On the downside, I'd say start to look at what's happening around anywhere between 110.25, 110.5. But already, if the buyers show up, if the dollar rally sellers show up, I think from here, 110.95 figure could already see buyers in euro dollar. So that will depend on combination of the ECB and those US data. So that is your first level. Then below there, it's going to be 110.25.35. If that's a big if, Lagarde all of a sudden turns negative and we see stronger US data, then why not, see a complete reversal of what we saw yesterday, and we could have a look sub 110. But that is a big if, okay? That is a big move from where we are. That would be like 150, 200 points move. It's not impossible, but if you look at the options pricing, they are completely ruling out such a big move right now. So, and if the options market, which is pretty deep, tells us that we don't have to expect too much volatility, we can expect interest both sides of those ranges as well. So that's for the euro. Yeah, for the cable, it's rallied back up from this support line up to it's 130.10 really, but that's good enough for government's work, as they say. We went really close to 130. So this 130, 130.10 is going to be the level this afternoon. I think blow through it, then we're probably going to see the highs again. If we cap around there, then I suppose that your first level really of interest is going to be somewhere around the lower end of 129, around 129.30. That's the first one to look at. If it breaks down there, then we're probably going to retest this trend line. It's really the toughest one of all, I think. Yes, it looks and the market really loves to sell dollars as well, and would love to buy the yen really, and have a good reason to buy the yen. We're really neutral here. We did go a little bit below this trend line, but I think this one is going to go into the bin, and we're rather going to watch the wider levels. So for today, and we all know that that's an important one. Yeah, I should look at it tomorrow. Really, the underside of the daily cloud is going to come in also just below 138. We have those prior lows. We have this trend line all happening in the 137s. This really is going to be the level of no return for the dollar yen. If ever it breaks down there, then something bigger is going on. Really, something bigger is going on. Based on what the options did, I would expect a first test here to find buyers or hedgers around on the back of those puts. So we could have, if the Bank of Japan does something, we could have, and then a bit of a rebound, and then perhaps the real sell-off. If you look at the top side, sorry, excuse me about it. And if you look at the top side, I think the 140.80, 140.115 is going to be your first zone right now, because we're trading well below. And then the bigger, let me just do a little bit in here. And then the bigger area we've spoken about is going to be 142 against your 139 that we spoke about here, which is on another time frame. So 139, 142, your first range, 137s, and 145 is the level of no return on the top side. Okay, we all agree about that one. That for the dollar yen, and I'm afraid I don't have anything tighter than that, because it's really going to be pretty volatile. I showed this euro yen is still around 155, 154.90. Again, we tested it, and we are already back above 156. Still very resilient. The combination ECB, Bank of Japan should tell us where this is going. If tomorrow, after the ECB, we are trading below and holding below 155, the party may be over for now, and there's probably at least 200, why not even 350 points to do there, if that would be the case. But for that, ECB needs to go neutral, at least, if not dovish, and Bank of Japan needs to strongly hint at doing stuff. Right, to the question on the Schweiz. So this is your weekly dollar Swiss, and it's really very heavy. The Swiss is still very much led. Well, first of all, the dollar has come under pressure, but the Swiss is also led by what the S&P is doing, right? And for that, we are going to have to have a look at the Euro Swiss, just because I always forget to put this one in. If you look at if the dollar would really continue on a weak trend, this thing could be heading for 83.80. Look at the 127 extension, the trend line here, 83.80. It is within the possibilities if the dollar continues to sell off on weaker data this afternoon and month end perhaps. We have to start to get back above 87.5, 87.60 to get back more to neutral and get back up to 89s or something. But for the time being, this is really looking still very weak. Euro Swiss, same thing. Despite the euro rebound, the Euro Swiss has continued to come off, right? And the thing on the Swiss is what I've always been saying. We are, if you want to know, or if you want to start to sell Swiss, for instance, we have to wait for a signal by the SNB saying that they are happy with everything and that they will stop buying Swiss franc to counter inflation. The day they come out with such a comment, then that is the day, I think, where Swiss has a chance to start weakening again. But for the time being, despite even their inflation also not being that high, I think it's around 2.5%, if that much. They are still guiding this thing lower for now, because they really said from the off, really, if you look back at here, really, they said that Swiss franc is a tool to combat inflation. And that's why I said, like, oh, this is a great night to buy Swiss in those days. I've tried to counter trade it a couple of times, but without success. And I'm just waiting. I'm just waiting for the SNB to give me a sign that they are ready to abandon their Swiss purchases. So that is Ali. What question have we not answered again?
That's an estimate of 9.16 billion. EPS.
I think we've covered enough for today.
Yeah.
20.
We've done a full hour again.
Swiss brand, yeah. Swiss brand is we used to have a correlation on the Swiss with risk, but risk is not coming off. If you look at equity markets, it's going up, but yet the Swiss is strengthening. So that's not like a natural correlation we are seeing there. So it's mostly guided by the SNB still. And I'm stopping there.
Yeah, thank you very much, boys and girls. Of course, if you want to ask more questions, you can always join us in our trading room. I know, Ali, you're thinking of getting in there at some point, so don't be a stranger. We'll also be back tomorrow, so you can catch us there. Have a great day for the rest of your day. Thank you to Kay, thank you to Stel for your valued input. Thank you for coming to the Flow Show, the rest of you guys and girls. Stay safe over the ECB, please, and we'll see you all tomorrow. Thank you very much.